Hey guys, today David and I are going to explain a DSCR loan. If you haven't heard about this, maybe you're just researching it, or maybe you've used one before. Hopefully, you can gain some insight on it. So, it's technically called a debt service cover ratio. Again, I've personally used one of these. It was a great experience. I couldn't. The reason I had to use one was because I didn't have the income, the legit income, they don't really count your real estate for another property that I wanted to buy. And so I technically couldn't qualify for a conventional mortgage as a investment property at the time. And so, but I found a property and I looked into a DSCR loan and it was the perfect fit. And I ended up using one. The other thing I really liked about it was that I was able to put the loan and the property directly into an LLC. So my name isn't really attached to it. Well, the LLC is owned by me, but the property itself is owned by the LLC, which I've only been able to do with my commercial properties. So all of my commercial properties, the loan is under my LLC. But for this property, even though with a conventional mortgage, it would have had to be under my name, regardless, with the DSCR loan, I was able to put it directly under an LLC. So that is a nice little added benefit to these to protect yourself when buying. David, do you kind of want to discuss what a DSCR loan is and
Yeah.
the facts?
Yeah. So as you mentioned, DSCR debt service coverage, and it's just a ratio that's determined by taking the property's net operating income, and you determine net operating income by you take the gross income minus the expenses. That gives you your net operating income, and the expenses don't include your debt service payment or your mortgage payment. Okay, so that's below net operating income. So you get your net operating income and you divide that by the total debt service, principal and interest payments of your loan. So your net operating income divided by your loan payment. And that gives you your debt service coverage ratio. Well, that's a way for lenders to determine the health of an investment property. And these type of loans are generally used on income producing properties like commercial buildings and multifamily properties, rental properties, that type of stuff. So they generally, lenders are looking for a debt service coverage ratio of 1.2, 1.3 on the high end. 1.25 is a real a place where a lot of commercial lenders will want to see a debt service coverage ratio coming in at. So for example, if your debt service coverage ratio is just 1.0, that would mean that the income, the NOI that the property is generating, the cash flow that the property is generating, I should say, is enough to make the payment. That's it. So you're basically breaking even, right? The cash flow is enough to make the payment. Well, if you have a debt service coverage ratio of 1.2, that would mean that, let's say that your monthly payment is $1,000 a month. That would mean that your NOI is at least, or your cash flow is at least $1,200. Okay, so $200 more than your monthly payment. That would be a debt service coverage ratio of 1.2. So hopefully that makes sense. The reality is the lenders use this as a metric to determine the risk of a loan. So the higher the debt service coverage ratio, the safer the loan is, and the better the terms are going to be for the borrower. The lower the debt service coverage ratio, and in some cases, there are lenders out there that will do a negative DSCR, or below 1, I should say. So like a 0.075. That would be pretty dramatic, but it would because they see the potential of the property. Maybe based upon current performance, it's not cash flow positive, but they also understand that there's a business plan that's in place for value add, where the owner is going to go in and add value to the property in some fashion or another. And when they get done with their renovations and increasing the tenant base and increasing the revenue, well, the debt service coverage ratio is going to be 1.45. So they could see this as a play to have a good property at the end of the business plan. So that, in a nutshell, is the debt service coverage ratio loan. And they're out there and becoming more common these days with rental properties. I think lenders, there's some, niche lenders out there. You're not going to find this product with your Fannie Mae, Freddie Mac sort of standard financing. They don't do these type of loans. These are, unique niche type lenders that are often balance sheet lenders, like they're lending their own money to borrowers. And so you're definitely going to be paying a premium in interest rate and points and terms. But they can be valuable loans for investors because they don't go on your own personal financial record. Just to your point, you held that property in your own name, in a business or an LLC, and it doesn't count against the limited number of conventional loans that you can get through Fannie Mae and Freddie Mac in your own personal name.
Yeah. Yeah, it's definitely an option to look into. I would say if you are really interested in having the property in an LLC and not in your name for one reason or another, or if you can't qualify for some reason for a conventional loan, that's definitely a great viable option to look into. That's it for today. For more daily investing tips and real estate secrets, don't forget to visit breakfreerealestate.com and make sure to like, subscribe, and share our podcast. We will see you tomorrow.